Welcome to This Explainer. I'm absolutely thrilled you're here, because today we're taking a topic that usually feels, well, incredibly intimidating and wrapped in heavy jargon, and we're going to completely demystify it. Finance can sometimes seem like this closed-off club, right? But by breaking it down visually, you'll see exactly how the mechanics of money actually work. We are talking about the fundamental engine driving our modern economy: financing.
Have you ever just stopped and wondered, how do people actually buy things they can't afford today? Think about the sheer scale of the things people purchase. Like, how does someone buy a $1 million house or a brand new car right off the lot? How do they fund a brand new tech startup or that local restaurant down the street without having the full cash amount just sitting there in their checking account? Most of us simply do not have decades to wait around, hoarding every single penny before we can live our lives or chase our dreams. And the answer to this massive, super relatable problem is exactly what we're exploring today.
Okay, let's dive into this. Here's our roadmap for today. We'll start with the power of financing. Compare debt versus equity. Look at financing in the real world, do a quick reality check on the pros, cons, and costs, and then wrap it all up with the bottom line.
Section 1. The power of financing. Demystifying how money works.
So think of financing as the ultimate bridge between where you are right now and where you want to be. The foundational concept is actually really simple. Financing basically means getting money from another person, a bank, or a financial institution to buy something today and then paying it back later. That's it. It's not some mystical dark art. It's just an agreement, an exchange of capital today for a promise of repayment tomorrow.
Let's make this super relatable. Picture this exact scenario. You have your eye on a motorcycle. It's perfect. It's exactly what you need for your daily commute. And it costs exactly $3,000. But you check your bank account and you only have $500. You're $2,500 short. Now, without financing, your only option is to just walk away and spend the next few years saving up, crossing your fingers that this specific motorcycle is still around when you finally get the cash.
But here's where that simple formula comes in. Financing equals using someone else's money today and repaying it over time. Instead of walking away from that bike, you go to a bank. The bank steps in, pays the seller that remaining $2,500, and you get to ride away on that motorcycle the very same day. In return, you agree to repay the bank every single month, along with a little extra money for their trouble, which, as you probably know, we call interest.
And when you zoom out to see how this builds into the bigger picture, it becomes so clear why this matters. Just take a look at these milestones: buying a home, purchasing a car, paying for higher education, starting a business, or expanding a company. Without the tool of financing, these massive life-defining moments would be completely out of reach for the vast majority of us. I mean, society as we know it would literally slow to a crawl if everyone had to pay 100% cash up front for, say, a college degree or a starter home.
All right, Section 2. Debt versus equity. The two main paths.
Now, what's really interesting here is the stark contrast between these two paths. With debt financing, you're borrowing money that absolutely must be repaid with interest. We're talking personal loans, home loans, credit cards. But on the flip side, with equity financing, you aren't borrowing at all. You're actually selling a part of your business to investors. You are sharing the ownership, the risk, and the eventual reward. So it really boils down to a choice between borrowing money or sharing your pie.
Let's break down the math of debt financing first. Say you borrow exactly $10,000. Well, the bank isn't doing this out of the goodness of their hearts, right? They charge interest. So over time, as you make your installments, you eventually repay a total of $11,000. That difference, that extra $1,000, is the cost of borrowing. It is the literal price you pay for the privilege of having that money in your hands today instead of waiting.
Now, flip that over to equity financing, which is incredibly common among startups. Say you start a tech company. You might not want the burden of a monthly loan payment hanging over your head while you're trying to grow. Instead, investors give you money, and in exchange, they become part owners. And here is the magic, and kind of the catch, of equity. If your business grows and makes millions, those investors benefit heavily right alongside you. But if the business loses money and goes under, well, they take the hit too. They share the financial risk. And crucially for you as the business owner, there are no mandatory monthly repayments like there are with debt.
Moving right along to Section 3. Financing in the real world. Everyday examples.
And this brilliantly illustrates the typical transaction most of us will go through at some point: buying a car. First, you find a car that costs $20,000. Next, you manage to put together a $5,000 down payment from your hard-earned savings. But you're still $15,000 short. So the bank steps in and finances that exact remaining amount, handing it directly to the dealership.
And finally, for the next 5 years, you make a predictable monthly payment to the bank. This is debt financing in its purest, most common, everyday form.
But what about the dreamers out there? Let's talk about starting a business. Imagine an aspiring entrepreneur who wants to open a restaurant. They've saved and saved, but they only have half the money required for the commercial kitchen equipment, the lease, and the staff. Instead of just throwing in the towel and giving up on their dream, a business loan bridges that gap. It allows them to actually open the doors, start serving food, and critically start earning the income they need to pay that loan back.
And then, of course, the biggest one of all, buying a house. I mean, very, very few people on this planet can just drop the full cash price for a house up front. There's no way. That is exactly why banks offer home financing, otherwise known as a mortgage. This is perhaps the most impactful use of financing in our entire society. It allows you to move your family into a home today, putting down roots, while you pay off the loan over 15, 20, or even 30 years.
Which brings us to Section 4, Pros, Cons, and Costs, the reality check. Okay, we need to take a beat and pivot here, because while financing is an absolutely incredible tool, it is definitely not free money. It comes with some very real strings attached, and it has to be used with caution. Weighing the options impartially, on the advantages side, yes, you get to buy expensive things right now. You can help a business grow rapidly. You can increase your future earning potential by financing an education. And if you manage it well, making those regular repayments builds a fantastic credit history. But you have to consider the disadvantages. Because of interest, the total cost of whatever you bought is always going to be higher than if you had paid cash. If you happen to miss a payment, you get hit with penalties and your credit tanks. And honestly, perhaps most importantly, taking on too much debt creates immense financial and psychological stress. Plus, there are always hidden conditions and fees that can lurk in the fine print if you aren't paying attention.
So, how do we actually handle this reality check? Well, our sources provide some really practical steps for managing these risks responsibly. First off, you absolutely must read the terms carefully to spot any of those additional fees before you sign anything. Seriously, read the fine print. Second, you have to maintain those regular repayments. Honestly, just automate them if you can to protect that vital credit history. And finally, you just have to be honest with yourself and avoid taking on too much debt. Look, just because a bank approves you for a massive amount doesn't mean it's actually a smart idea to take it all.
And that leads us to Section 5, the bottom line, final takeaway. To quickly recap everything we've built today, financing is simply getting money today to achieve a goal and paying it back over time. That happens whether it's through debt, where you borrow and repay with interest, or equity, where you trade ownership for capital. It's the mechanism that powers growth, education, and major life milestones. But I want to leave you with this golden rule. Only borrow what you can realistically afford to repay. It is such a simple sentence, but it is the absolute foundation of financial health. You see, when used responsibly, financing unlocks the world. When used recklessly, it becomes a trap. So, looking at your own goals right now, are you leveraging financing to build your future, or are you borrowing more than you can truly afford? Something to think about. Thanks for joining me on this explainer, and keep learning.